Get ready for the biggest market shakeup of the year. We start with SpaceX, as the anticipation for its public listing builds to an incredible fever pitch. We're diving deep into how investors can position themselves before the IPO, exploring the crucial questions every single investor needs to ask about the investment vehicles available right now to make sure you capture the true value of this space giant. And finally, we get the immediate operational update. We're looking at the latest from SpaceX, as the company targets a new launch date for its 12th Starship flight test, setting the stage for what's next. Don't miss a second of this action. Subscribe now and get the analysis you need to navigate this future. As SpaceX prepares for its anticipated initial public offering, potentially in mid-June, regulated fund vehicles offer investors multiple pathways to gain exposure before the listing. The selection of the appropriate vehicle is critical, as structural differences can significantly impact whether an investor captures the underlying investment thesis. A comprehensive diligence framework, centered on 5 key questions, is essential for navigating these options. The 5 essential questions every investor should ask when evaluating regulated vehicles offering exposure to SpaceX or comparable private companies are: 1. What is the actual cost of ownership? Total cost of ownership is often misrepresented. Management fees vary dramatically, ranging from low basis points in some vehicles to several percent in others. Investors must scrutinize these expenses to ensure lower costs preserve more of the potential returns over the long term. 2. Can the investor exit when desired? Liquidity is a structural issue. Exchange-traded funds offer intraday trading flexibility. Interval funds, however, impose strict redemption windows, often limited to quarterly periods with caps on withdrawals. These structural restrictions can severely limit an investor's ability to exit a position quickly during favorable market conditions. 3. Is the investor paying a premium to the underlying value? Closed-end funds concentrated on specific private names can trade at significant premiums to net asset value, sometimes reaching 10 or 20 times NAV. These premiums are not always durable and can compress sharply when the underlying catalyst fades, leaving investors who paid the premium vulnerable to losses. 4. How current is the valuation of the private position? Stale markings present a hidden risk. Investors should demand a disciplined cadence for revaluing private holdings to ensure the published net asset value accurately reflects current market realities. 5. Does the fund pass the full upside through to the shareholder? This question highlights significant structural differences. Some investment vehicles may involve layered management fees or gain-sharing structures that divert appreciation away from the shareholder. Investors must confirm that all gains flow directly to the fund's net asset value. These 5 questions are not abstract. They have direct economic consequences, particularly concerning IPO dynamics. Historical data from 15 consequential technology IPOs shows that investors buying near the pre-lockup peak often experience substantial drawdowns following the lockup expiration. The combined effect of peak appreciation followed by post-lockup volatility can result in a significantly smaller net return than the headline peak suggests. Ultimately, the choice of wrapper, ETF, interval fund, or closed-end fund determines the investor's ability to monetize the investment thesis. Liquidity and structural transparency are are not mere preferences. They are crucial determinants of whether an investor can act on market data and realize the full potential of their investment. Applying this framework ensures that investors are not unknowingly paying a structural toll on the upside they are betting on, regardless of the specific security chosen. Wall Street is anticipating an unprecedented wave of massive initial public offerings, headlined by major technology players including SpaceX, OpenAI, and Anthropic, setting the stage for a period of extreme risk and reward. SpaceX is slated to launch an IPO in June, aiming to raise up to $80 billion, nearly double the funds expected from all 2025 IPOs. Following this, rivals in the artificial intelligence sector, OpenAI and Anthropic, are also targeting significant listings, with each company eyeing fundraising totals around $60 billion, pushing valuations toward the $1 trillion mark. Industry analysts describe the current environment as unprecedented, noting an extreme concentration of these megalistings. While geopolitical tensions from the Middle East and inflationary pressures are present, experts believe these factors are unlikely to impede the IPOs of these unique companies. Specialists suggest there is sufficient capital available for these offerings if pricing is accurate. In a move to recognize these listings, Nasdaq has accelerated the timeframe for including such major companies in its main benchmark index, which is expected to drive increased investment interest in SpaceX from index-related funds. Secondary markets are also seeing intense activity, with investors buying unlisted securities, pushing Anthropic's theoretical valuation past $1 trillion. Investors are keenly watching the debut performance of these public companies, particularly OpenAI and Anthropic, as a litmus test for the market's appetite for further AI-related offerings. Analyst Emily Zheng noted that strong performance would validate current private market valuations, whereas underperformance could signal overvaluation. Furthermore, the transition to public markets will subject these companies to intense operational scrutiny. Mark Roberts of the Blueshirt Group emphasized that the market will be laser-focused on the performance of those stocks from an operational perspective. Despite the potential upside, volatility is expected. Jay Ritter predicts significant swings in stock prices due to the uncertainty surrounding the future, cautioning that owning these stocks involves substantial risk. The situation also reflects broader private market dynamics, as some investors may look to cash out of private holdings, potentially impacting valuations for other private companies, as private equity firms face a slowdown in exits. SpaceX is gearing up for what is slated to be the largest initial public offering in history, targeting an astonishing $1.75 trillion valuation upon listing on the Nasdaq under the ticker symbol SPCX on June 12, 2026. This monumental offering is set to raise approximately $75 billion, marking a watershed moment for both the aerospace industry and global financial markets. The launch comes after SpaceX's recent merger with Elon Musk's artificial intelligence company, xAI, creating a combined entity poised to redefine multiple sectors. The investment thesis for SpaceX is built on fundamental disruption, radically reducing launch costs, building the world's largest satellite constellation via Starlink, and achieving deep vertical integration spanning rocket manufacturing, satellite deployment, and now AI. This unique combination makes it a compelling proposition for institutional and retail investors alike. The IPO timeline has been accelerated, with the prospectus expected by May 20, marketing commencing June 4, and pricing anticipated on June 11, following a faster-than-expected review by the U.S. Securities and Exchange Commission. The ticker symbol SPCX is notable, having previously been associated with a SPAC ETF. At a $1.75 trillion valuation, SpaceX would instantly rank among the top 10 most valuable companies globally, surpassing giants like Meta, Berkshire Hathaway, and Tesla. This figure represents a significant five-fold appreciation from just 12 months ago, fueled by the xAI integration narrative and the maturation of Starlink revenue. However, the valuation faces intense scrutiny. Based on 10 times 2025 revenue of $18.67 billion, the $1.75 trillion target implies an extraordinary premium. Analysts suggest this valuation hinges on achieving substantial growth, projecting 2030 revenue exceeding $150 billion at a 12x multiple, demanding flawless execution across Starlink expansion, AI initiatives, and Mars colonization efforts. The merger with xAI is central to the new strategy, aiming to leverage Starlink's global network for distributed AI computing and grant xAI access to real-time data. Despite the synergy potential, the integration has added complexity, including absorbing a reported $4.94 billion loss from the transaction. Starlink remains the core revenue engine, generating about $12 billion annually from over 5 million subscribers. This is complemented by stable government contracts, which account for roughly 35% of total revenue, and the growing potential of the Starship program, which is validated by NASA's selection for the Artemis lunar lander. SpaceX possesses a formidable competitive moat due to its vertical integration and operational experience, particularly in reusable rocketry and the massive capital barrier established by its 7,000-plus Starlink satellites. This first-mover advantage provides strong defensive positioning. For individual investors, securing shares at the IPO price will be challenging, as underwriting syndicates prioritize institutional allocations. Retail investors should prepare for volatility and consider dollar-cost averaging. Alternatives for exposure to the space economy include ETFs like ARKX or satellite operators such as Iridium Communications. Key risks remain significant. Skeptics question the justification for the valuation based on current revenue multiples and warn that the price assumes flawless execution across multiple, complex business lines. Furthermore, the company faces regulatory hurdles across aerospace, telecommunications, and AI, and political developments affecting government contracts introduce material risk. The complexity of the multi-industry structure also presents classification challenges. Ultimately, SpaceX's IPO is a defining event. Proponents argue the valuation reflects transformative potential, while skeptics caution against speculative excess and the concentration of risk. Investors are advised to approach SpaceX with a long-term horizon and careful risk management, recognizing that the success of this venture will shape the future of space, technology, and global finance. SpaceX has announced a revised launch date for the 12th flight test of its Starship vehicle, scheduled to take place from Starbase in Cameron County, Texas. The new target date is Wednesday, May 20, with the launch window commencing at 5:30 p.m. The operation is expected to necessitate temporary closures of State Highway 4 and Boca Chica Beach. SpaceX is preparing to establish a safety zone perimeter in close coordination with local law enforcement to ensure public safety during the test. Authorities note that the target date remains subject to change based on various factors. The city of Starbase will issue public notices regarding the temporary closures of Boca Chica Beach and State Highway 4 to residents and travelers.